us. Partha DeSarkar, the CEO of the company, joining us, giving us a perspective on the Q3 numbers. Mr. Sarkar, thank you so much for joining us on ET Now. Firstly, congratulations. It's been a good growth and robust performance as well on the operating as well as on the net level. Do you see the benefit of positive seasonality and even higher capacity utilization extending into Q4 as well?
You're absolutely right. What has happened is we've been able to improve our capacity utilization by almost 300 basis points. So it's gone up from 85% to about 88%. And as you correctly said, that's driven a lot by our seasonality. So our seasonality comes from two industries. The industry that impacts the seasonality most is the healthcare industry and also the consumer electronics industry. So the both kind of peak at this point of time. So that has helped us to drive profitability up. And it's actually a very tough game to be able to manage both top line growth and profitability growth. So we are firmly in the middle of our turnaround momentum. And you're seeing that we've been able to manage a constant currency growth of about 8.3%. So that's reasonably good growth. But I think the focus has been on profitable growth. And that's why you will see that the EBITDA margins have improved so dramatically as compared to last year. So yes, it's a tough act, but we've been able to pull it off successfully for the next 3 quarters, for the last 3 quarters.
Okay, and also can you tell us what is the uptick in volumes that you're seeing from the top 10 clients, and how do you envision ramp up from new logos in healthcare and consumer products shaping up in the subsequent quarters?
See, our growth momentum will continue is the visibility that we have. As I said, we're trying to balance growth with profitability. So ramp up, historically we've been able to give a CAGR of about 20%. And that in terms of headcount would convert to about, let's say, 1,000 to 2,000. Sometimes it's, because of seasonality, the number doubles, almost 1,000 to 2,000 per quarter. So that's coming from our top 10 logo. Most of them are healthcare. We continue to focus on healthcare. We are also expanding our consumer portfolio. E-tail, for example, we've got one of the world's largest e-tailers. That's ramping up very well. So overall growth perspective, I think we are very confident that we'll be able to grow well. And most of the growth will come from our top 10 accounts. New logo growth, if you know, the new logo growth typically would end up being $1 million or $2 million from any client. So even if that grows by 100%, that's going to be $2 million on top of a $2 million base, right? When existing client who's already $70 million, even if he grows by 10%, that's $7 million. So it's going to be concentrated towards the top 10 guys. But new logo growth has also been a reasonable number this time.
Okay, and of course you did talk about, attending to different clients as well, apart from, of course, your usual ones. But, this is a time when client spending is getting finalized. Are you sensing a reduced spend commitment or delays in deal conversions in probably select markets or specific large clients?
Well, you know what? Our business actually impacts OPEX. We are not a CAPEX-driven service. So the spend commitments that our clients have typically would impact the IT sector more than the BPM sector. So every client of ours will have a savings target, and that's why we help them being more competitive in the marketplace. So typically their increase in outsourcing spends help us drive their profitability higher. So we don't see their spends impacting our growth. Typically, their increase in budget and outsourcing helps them with their margins, and that drives our growth. So it's a little contrarian. The one market that we have a certain amount of slowdown that we are seeing is in the UK market. That's one market that we are watching. But other than that, I don't see anything that the budgets of our clients impacting our growth. In fact, as I explained, generally budget time is when they are telling us how much they want to give us more next year. So it's always a good time for us.
Okay, that's actually quite encouraging to hear. You know, your 9-month revenue has grown by 15%, operating profits by 41%. Do you think that you could be able to maintain this momentum, you know, in both these parameters in FY18 as well, and, you know, especially given the protectionist measures, etc., in the US markets?
So you brought up a very interesting point. See, our revenue model is a little different. We have about 60% of our revenues coming onshore. So protectionist measures impact us less than probably our peer group. We create jobs onshore in US, Canada, and UK. In fact, we've added about 1,200 jobs in North America in this quarter. So protectionism doesn't really impact us that much. Your first question, whether we'll be able to deliver top line growth and bottom line growth together, that, as I said, is a fairly challenging task, but this year we've been able to do it, and you know, it's just a question of replicating what we did this year next year as well. As of now, I don't see any concern in pulling that off next year as well, but it's a little forward looking, so let me just keep it at that. You know, we're still working through our numbers.
Okay. All right, thanks for joining in and giving us a view on how things have shaped up for the company. It's been a stock that has been quite a strong performer in the long haul. The management is pretty upbeat on prospects going forward.